Good morning everyone, I'm Ken, financial analyst from Regain Capital, and welcome to our morning market briefing on the 10th of November, Tuesday. So as usual, in our market briefing, we will cover three parts, namely the fundamentals, the news release, and the technical analysis. So without further ado, let's start off with the fundamentals. Now, the market has experienced a large fluctuations on Monday, as we can see from the market movement, where gold plunged by 4.58%, the US dollar fell against the Canadian dollar as much as 0.37%, the dollar index rebounded by 0.71%, and oil surging by 6.51%. So let's get into further details with the headlines of today. First off, the surge in oil was due to the positive news of an effective vaccine. Now, the crude oil surged to a session high of 41.5 on Monday after US pharmaceutical company Pfizer announced a COVID-19 vaccine that proved to be 90% effective in its latest trial. Now, the black commodities demand had plummeted throughout the year 2020 as the pandemic jeopardized large oil consumption sectors such as the airline sectors, and the vaccine news had led investors rushing into risky stocks and commodities market in expectations that the economy is able to undergo a speedy recovery with the vaccine. So instruments involved here would be crude oil, and supporting the Canadian dollar is also the rise in the price of crude oil, as Canada's economy depends highly on the prices of crude oil. Moving on, let's discuss on yesterday's fall in the gold market, and not only the gold but also other safe haven assets such as the Swiss franc and the Japanese yen. Now, market risk sentiment took a turn on Monday following the news of an effective vaccine, which surprised the market. Now, investors' boosted risk appetite had led to a major sell-off in the safe haven gold and yen, causing the metal to tumble more than $100 a troy ounce. Now, as the vaccine is still waiting for regulatory approval, a mass rollout of the vaccine could shift gold's long-term uptrend downwards. So instruments involved here would be gold itself. Moving on, let's take a look at the news release for today. So please take note, time stated here are at GMT plus 8. First data would be at 3 PM from the UK, where they'll be releasing its climate count change, which is also known as the unemployment change. Thus, a higher reading indicate that the number of unemployed people are increasing in the country, and it would be bad for the currency. So for the data is forecasted to be at 50,000 compared to previous month of 28,000. So any reading higher than the 50,000 would exert negative pressure onto the pound. And at 6 PM would be the German ZEW economic sentiment, where it is expected to fall lower from previous month of 56.1 to 41.7. Now, the fall in the economic sentiment in Germany is most likely due to the recent rise in the COVID-19 infections, thus causing investors to be less confident towards the euro's economic recovery. So any reading below the forecasted value would exert negative pressure onto the euro. So that's all for the news release. Moving on, let's take a look at the technicals. So here's an overview of instruments to be covered. First off, USD CHF H4 chart signaling an uptrend. Canadian dollar Japanese yen H4 chart showing an uptrend. For the US oil or the crude oil in its H4 chart showing an uptrend. And for gold now signaling a possible downtrend in its H4 chart. So let's get into further details with the chart analysis, starting with the USD CHF. So overall, first, when we take a look at the daily chart, we can see that the pair has rebounded off its lowest level reached yesterday near 0.8980, as it extended with a long bullish candle all the way to its 60 moving average. So moving back to its H4 chart, constructing the Fibonacci from the previous high to the low, signaling a possible change in trend, we can see that the pair managed to break both the 23.6 and the 38.2 Fibonacci to now testing the 50.0 Fibonacci near 0.9140. Overall, MACD showing a bullish momentum and also building up, suggests the pair to extend higher after successfully breaking above the 50.0 Fibonacci. So cautious investors are advised to consider long positions after the breakout above the 50-point Fibonacci, with a stop loss 30 pips from the level at 0.9110 and a take profit first targeted at close to the 61.8 at 0.9180, and a further target would be the next resistance close to 0.9230. Whereas for aggressive investors, if the pair fails to break above the 50-point Fibonacci, aggressive investors can then consider short positions with a stop loss and take profit of 30 and 50 pips respectively. Next, for the pair of Canadian dollar, Japanese yen. So pulling back, we need to obtain the high levels from here for the pair, and towards the bottom level over here, we can see that the pair attempted to reach the previous high at 81.6. However, before reaching the level, the pair faced some rejections and some pressure back towards the middle point of between the 100-point Fibonacci and the 61.8 Fibonacci. So most likely the pair is experienced to further its technical correction to the level of 80.6 before extending its overall long-term trend. So following the MACD, cautious investors are advised to enter into long positions after the retracement back towards the level near 80.6. Stop loss should be placed 30 pips from the level at 80.3, and the take profit can be set 60 pips from the level all the way to its 81.2. Whereas for aggressive investors, if the pair breaks below the support zone near 80.6, aggressive investors can consider short positions with a stop loss around 30 pips at 80.9 and a take profit around 50 pips close to 80.1. Next, for the oil in this H4 chart. Now we can see that oil yesterday has attempted to test the resistance reached previously at 41.5 and is now trading back below towards the support zone near 39.3. So overall, we can see that the commodity has extended gains throughout last Friday and also on Monday to reach a session high back towards the previous sideways channel where we have discussed previously. So overall, with the fundamental support of an effective vaccine, crude oil can now attempt to further its trend in the long term, focusing on an uptrend. So cautious investors are advised to wait for further retracement and to enter a long market around 39.3. Stop loss should be placed 80 pips from the level at 38.5, and a take profit can be set 160 pips from the entry point at 40.9. So 40.9. Whereas for aggressive investors, if the crude oil breaks below the support level of 39.3, aggressive investors can consider short-term short positions with a stop loss around 50 pips and a take profit around 100 pips. Lastly, for gold in the H4 chart. Now we can see that gold is yesterday has reached the bottom level close to the 1850 support level, and we can see yesterday's trading of the H4 candle where it fell from the highest level at 1963, falling more than $100 a troy ounce or 1,000 pips all the way to its support at 1850 before rebounding. So overall, we would wait for the gold might be changing its long-term trend with yesterday's bearish engulfing over here. So we will wait for a breakout below the 1850 before entering into short positions for the gold. So after the breakout, the next support zone could be near towards the 200 moving average at 1820. So overall, we'll wait for a breakout below the support level before entering into short positions, where after the breakout, the stop loss should be placed 100 pips from the level at 1860, and the take profit can be targeted 200 pips at 1830. However, if gold fails to extend lower and breaks above the 1880 resistance, then aggressive investors can consider long positions. Stop loss should be placed 50 pips from the level at 1875 and a take profit of 100 pips close to 1890. So that is all for our market briefing. Please remember to follow us on our social media such as Facebook, Telegram, Twitter, as well as Instagram. And feel free to drop by our website at www.regaincapital.com to get updated on all the latest market news as well as education posts for our clients. So thank you all for listening. We'll see you next time on our market briefing, and happy trading to all.